Hello everyone, welcome back to today's lecture. In this session, we're going to cover one of the most important topics in accounting, financial accounting and reporting. By the end of this lecture, you'll clearly understand how businesses record transactions and prepare financial statements. So, let's get started. So first of all, what is financial accounting? Financial accounting is the process of recording, classifying, summarizing, and reporting financial transactions of a business. Now the key point here is, this information is mainly prepared for external users. For example, investors, banks, and government authorities use these reports to make decisions. Now let's talk about the three main financial statements. First, we have the Statement of Financial Position, also known as the balance sheet. This shows what the business owns and what it owes. We use a very important equation here. Assets equals liabilities plus equity. Assets are things the business owns, like cash or inventory. Liabilities are obligations, like loans. And equity is the owner's share. Next, we have the Statement of Profit or Loss. This tells us whether the business is making a profit or a loss. Very simple formula. Profit equals revenue minus expenses. If revenue is higher than expenses, the business is profitable. Lastly, the Statement of Cash Flows. This tracks how cash moves in and out of the business. There are three types of activities: operating, investing, and financing. Now let's discuss some important accounting concepts. First is the accrual concept. We record income and expenses when they occur, not when cash is received. Then we have going concern. We assume the business will continue in the future. Next is consistency. Use the same accounting methods every year. And finally, prudence. Always be careful. Do not overstate profits. Every transaction has two sides. For example, if you buy goods for cash, purchases increase and cash decreases. So we debit one account and credit another. And remember, debit always equals credit. Now let's quickly look at depreciation. Depreciation means the value of an asset decreases over time. For example, a machine loses value every year. We often use the straight line method to calculate it. Inventory is also very important. We have methods like FIFO, first in, first out, and average cost. These help us calculate the cost of goods sold and profit. Companies follow standards like IFRS. This ensures reports are accurate and consistent worldwide. We also use ratio analysis to evaluate performance. For example, profitability ratios, liquidity ratios, and efficiency ratios. Sometimes mistakes happen in accounting. Common errors include omission, commission, and principal errors. So to summarize, financial accounting helps us track business performance, prepare financial statements, and support decision-making. Before we end, here's a quick question for you. If a business has revenue of $100,000 and expenses of $70,000, what is the profit? Think about it and we'll discuss it in the next class. That's all for today's lecture. If you found this helpful, make sure to revise these concepts and practice questions. See you in the next class.